All right. Hey, what's up, people? This is your boy Drew over here at Average Joe Investing. I just wanted to start off by thanking everybody who's checking out the channel. I'm slowly growing and hope to continue growing with each and every one of y'all. New segment that I want to start today, and I pretty much want to try to do every day if possible. Keyword there, if possible, is I want to do news, investing in the stock market, what potential news over the weekends or weekdays and change factors within the market. And so going into this week, you'll see this video this Sunday. So going into this week, I want you to have a clear head about what the potentials are for this Monday and what factors are affecting our investments this Monday. As well, be sure to check out all the other videos. I've got a video up about ETFs, how to start investing in the stock market, smart ways to start investing, safe ways to start investing. So without further ado, let's get on over here and let's check out some of the news for this week. All right, perfect. So what I've got pulled up for you is just a very broad stock market news search here on Google. And I like to just check over and glance over the first few articles that pop up because these are the main important ones. These are the ones that everybody's going to be looking for this week, and these are the ones everybody's going to be hitting on. Okay, so let's see. We've got Market Watch. Stock market faces the most massive miscalculation of capital in history. Will the Fed rate hikes crush the stock market? Here's why speed matters. So we're going to read this article or jump into a little bit about this article, but the first thing I want to hit on is, to be honest, when it comes to the Fed rate hikes, I'm to the point right now where I just need them to happen. I'm tired of talking about them. I'm tired of every month them being a factor. I mean, they've been a factor since November, for Christ's sakes. And if you want to talk about stock markets crashing and down days, what do they generally have to do? They have to do with the Fed, they have to do with the rate hikes, and they have to do with inflation. Well, we've got to get inflation under control to stop dealing with the rate hikes, to get the Fed back out of our heads. So at the end of the day, rate hike the hell of it up, rake it all the way up, crash the markets immediately, have the markets price it all in, and then let's go from there. Because this day in and day out, month in, month out, Fed rate hikes, it's absolutely ludicrous. All right, so will they crash the market? Why speed matters. This might even be hitting on what I'm talking about. All right, so with the Federal Reserve all but certain to begin raising interest rates in March, prognosticators have been quick to reassure investors that history shows stocks tend to do just fine as policymakers embark on monetary policy tightening cycle. And that's true. I mean, before COVID, we had interest rates, and long story short, the market was doing great. So let's say it turns out when the Fed moves to hike rates, when the Fed moves fast to hike rates, as it has signaled it's prepared to do in the scramble to rein in U.S. inflation running at its hottest since the 1980s, the stock market short-term performance hasn't been quite as stellar, said Chief U.S. Strategist Ned Davis. It's intuitive that the Fed's job when they start raising rates is to take the punch bowl away before the party gets going too much. So it shouldn't be a surprise that the quicker they've been, the more the markets have taken note. Overall, the return and drawdown statistics of fast cycles are consistent with choppy conditions, but not necessarily a major bear market. So how fast is fast? It's a bit subjective, but past cycles have shaken up relatively clearly between two categories. NDR expects 4 more rate increases in the Fed's 7 remaining policy meetings in 2022, alongside the start reduction size of the central bank's balance sheet. That's another thing. We got to stop printing money like it's just going out of style. I get it that it's going back into people's pockets through stimulus and supposedly back into the economy. But why do you think we have inflation? I mean, we have given the American people more money than they know what to deal with. And what did they do? They went out and spent it. And so let's just be serious. You open up a business, you want as much money as you can get, and people are going to come in and buy. Why not raise it if they're still going to pay for it? I mean, Apple charges $420 to make an iPhone, and then we'll charge you $1,200 for it. I mean, if you're going to pay for it, they're going to do it. The market's pricing of an aggressive rate hike scenario appears reasonable given the inflation picture. That said, it's worth remembering that both the market and the Fed itself, via central bank so-called dot plot forecasts for benchmark interest rates, have been relatively poor at predicting actual rates. Okay. So I mean that was just so much mumbo jumbo. Plain and simple. The market is priced in about 0.5% rate increase already. And that's really where I want them to start. I don't want to start out at 0.25%. I mean, if we could literally go to 1% without crashing the entire market, I would say go right on ahead. Obviously, that would crash the entire markets, and they won't do that. But at this point, we got to get inflation under control because I need my money to start working for me. And I'm pretty sure you all feel the same way. All right, so let's go back here. Let's see what we got now. Russia's Ukraine threats. I'm going to get into that in just a minute. Futures. All right, let's check out more news. Let's see what we got. Okay, so plain and simple, the news is basically focused around Russia and the Fed raising rates. So that's what we have for news going in. Be aware that if the Fed says anything or if anybody comes out about Fed news, unless it's looking really, really good, like inflation is going down, expect all that news to sort of take precedent and not crash the markets, but look for blood in the streets when they talk about that. All right, on to the next topic. What's the next thing that's messing with the markets right now? Very simple. Russia, Ukraine. If you ask me why it's messing with the markets, I have no idea. Maybe oil. But let's just be real. American people don't like war. They don't like uncertainty when it comes to potential wars or U.S. involving themselves into conflicts outside of our country. And so with that, some of the big things today is Zelensky, who is I believe a prime minister in Ukraine. I believe that's what they're called in Ukraine. Let's find out. President said Saturday that sanctions on Russia should be made public before a possible invasion of Ukraine occurs as tensions between Western nations and Russia continue to intensify. So what he's looking there is for like sanctions that we've put on Korea and places like that. They're looking for that to try to divert Russia from doing what it looks like they're going to be doing, which last week they said they were going to start moving troops back. But in this case, really and truly, it's the U.S. media has been, in my opinion, stirring up the pot because Vladimir said he was heading out. But even the moment that he said they were heading out, I mean, you had U.S. markets sitting there going, nope, he's going nowhere. It looks like more troops on the border. At the end of the day, who really knows how much is out there unless you're out there? So yeah, let's go back. So basically sanctions to try to get Russia to back down. Continuing on that, Ukraine will not respond to provocations. So long story short, there's been some artillery shootings out there from what people have heard. If anything, it's more like a scare tactic, and Ukraine's basically saying they're not having it. So, long story short, if this continues and the talks of a potential war between Russia and Ukraine continue to intensify, expect the first couple of days of this week to be red. And how far red? Who really knows? I mean, I can tell you that on Friday, the markets looked like they were going back up, say after around noon, and it looked like we were going to have some green in the day. And then literally news breaks, the suits are sitting there reading this stuff, and tensions are intensifying. And when that happens, long story short, people start throwing away. They start talking to their fund managers. I got to get out of here before I lose my money. If this continues, then expect Monday to just be a bloodbath. All right, let's look up Fed news real quick. Fed approves rules banning officials from trading stocks, bonds. Okay. So I always just like to see if they're saying anything specific to the Fed, like maybe Jerome Powell. And let's check out Jerome Powell. Looks like no news and notes on him. And don't expect much, really, from here on out until around the week of the 14th. Okay, so with that, it looks like coming Monday morning, unless things change late Sunday evening, do expect the market to be either very mixed or red, or blood in the water because of the tensions with Ukraine. As well, let me know what your opinions are when it comes to the rate hikes. I know that the lower the rates are, generally the stock market does really, really well. But at this point, with inflation going off as far as it has and being as high as it has been since the 80s, We just need to get it under control. I mean, historically, there's been a recession every single time that we've gone above 5%. We're above 5%. The last thing we really want is a recession. We don't need the markets to basically burn for about 16 to 18 months. That's not what I'm looking for. So let's see. Hopefully, the CPI data come in March, start showing inflation going down, and we can change the trajectory that we're on right now. But yeah, so as it comes for investing, if you're new to investing, be sure to start investing. Even though there's a lot of bad news out, there's also a lot of great buys right now. Don't be afraid to throw your money in. Just be prepared. Set it up into thirds. Buy at one strike. And then if it goes down, buy another one at another strike. If it goes further than that, hit it again. That way you're dollar cost averaging in. And by the end of your buy-ins, you are buying in at the lowest rate possible. And when it shoots off to the moon, you're riding along with it. Don't be afraid of the markets. Don't let the market scare you. Don't let the news scare you. At the end of the day, you can invest the day before a recession and you will be on top afterward. But yeah, so thank you for checking me out today. My name is Drew. This is Average Joe Investing. Let's get our hands dirty. Let's get our money into the market and let's get this bad news out of the way. All right, peace.